Chapter 1: The Business of Investing. Most Indians confuse stocks and shares to be exact synonyms of socks and stairs. A majority of Indians considers investing as an extension of gambling and have no distinction to make between investing, speculating, and gambling. Those traditional minded Indians assume the stock market to exist only as a get rich quick scheme, and irrespective of the odds, the very act of engaging in a game of uncertain outcomes is assumed to be the quickest route to bankruptcy. The traditional Indian households has thus valued land, gold and bank fixed deposits much ahead of stocks and shares. Maybe because it takes less skills to buy a piece of land or make a bank fixed deposit, and even lesser thought to buy gold that than it does to buy a bunch of stocks. Personally, I have all my money in equities and have not bought any gold or real estate ever, because I feel more comfortable making investment with an open-ended dream of creating an outsized gain, an event that is more likely to happen by buying a share of a business than by putting money in any other asset class. As a consequence to this traditional mindset, the percentage of Indians who think that wealth can be made by investing in stocks through pure fundamental research remains abysmally poor. Corporate profits, free cash flow, dividends, and growth rates mean nothing to the traditional Indian household, most of whom consider these numbers manipulated and meaningless. The strange belief in the orthodox thinking process is that there are only two things that can make money in the market. First is an access to a large Mumbai based operator or someone in a company who can tip off an information before the event actually happens, and secondly, a premise that one has to be absolutely lucky to make money, as the reverberating thought is that the game of uncertainty can be captured only by stroke of chance. In reality, both these aspects provide the greatest danger to an investor's wealth, as there are no free lunch available both in life and in the market. Most insiders, for reasons yet unknown to the investing community, prefer to recommend rather than invest, and the insiders who invest do not recommend. The tip off from the father in law's stepbrothers working as a dealer in the trading desk of the largest operator in the country is a sure shot way to portfolio destruction, as no operator recommends a stock before buying, nor does he make a public announcement before selling. This makes the entire process of sharing information for charity completely misconceived and faulty. However, the idea of being provided with ready-made buying tips is always preferred to the process of undertaking serious research on the stocks that an investor wants to buy, because hearing is always perceived earlier to thinking. It isn't at all ironic that the word tip, spelt backward, is pit, a place where most investors land when the tip backfires. Gains from investing are non-linear. Many first-time participants consider the stock market as an avenue of making regular income, not realizing that the market does not care if there is an immediate bill to be paid or debt to be relinquished. The stock market is not a game which promises to pay an investor's monthly expenses by generating periodic returns, as the gains, if any, comes with a lag. Since the gains are non-linear and come in bunches, while expenses are linear and have to be paid off periodically, there remains a permanent mismatch in paying off the expenses from the stock market gains. Once the size of the portfolio increases, an investor can choose to pay off his expenses by his dividend income, which, in spite of being received once or twice a year, is broadly defined in character. Much like the investor's expense and quite unlike the capital gains that arises from the buying and selling of shares. No better business. The big advantage of the investing in listed equities is the absence of minimum threshold limit. An investor with a capital of 10,000 can participate in the fortune of a textile business as easy as he can buy a share of a steel company without there being any obstruction on the smallness of the amount. The actual process and cost for an investor, if he were to completely set up such business on his own, would be significantly prohibitive. There is something called critical mass which entrepreneurs are supposed to bring to the table, but an investor suffers from no such requirement. An investor who buys stocks this way looks at being a part owner of a business whose fortunes are tied to the earnings potential of the company that he owns. A long term owner of shares should consider these entitlement certificates, means shares, either in paper or electronic form, as ownership rights to a business and a means of participating in the company's fortune with limited capital, even though in the short period the value of these shares could rise and fall without any reason. But if the company does well, it would over a period of time reward its owners both through dividends and capital appreciation. All that an investor has to do is to back his decision with homework rather than hearsay. Another advantage of equity investing is the ease of access. If the owner of a business tries to sell off his company, then it could take weeks or maybe months to locate an appropriate suitor. But in the stock market, such deals happen at the click of a mouse. Unlike the real world, where buying and selling of business happens through private deals in totality, the stock market enables trading of partial ownership rights. The change in price of shares is more frequent than a change in value of the business, and it takes a lot of experience and understanding to note that the frequency of change is higher for price than it is for value, even though instead of being worried by a change in value, most investors remain more concerned by the change in price. Price discovery is a mix of emotions and reasons. The value of these ownership rights are influenced as much as by fundamentals of the underlying business as they are by the emotions of the participants. An investor can sell when there is euphoria and buy when there is panic, because the fundamental price of a business is inflated by optimism in a bull market and deflated for pessimism in a bearish one. Though every market participant like to categorize himself as a value investor, the price which he pays for a stock either exceeds the value during a bull market or falls below it during a bear market, as bull markets are built on enthusiasm, whereas bear markets thrive on pessimism. Expectations about future prices is one of the chief cause of bull market euphoria and bear market panics. When people expecting higher prices, they don't mind buying something for more than what it worth today, as long as they are confident of selling it at an even higher price tomorrow. The cycle repeats itself and is often touted as a greater fool's theory, where each fool looks for bigger fool, and when there are no more fools to be made, the last fool in the chain is made up to pay, an event that brings the entire bull market to a stop. Price is what we pay, value is what we get. In bull market, price can keep getting greater than the value. In bear market, value can keep getting greater than price. A similar case repeats itself during a bear market, where an investor worried about lower prices looks to sell something for less than what it is worthy today. Here, the fundamental price of a share is reduced by the fear factor, as prices keeps falling lower than what they should actually be. However, in practice, it is very difficult to understand whether price is ahead of value or below it. The only takeaway an investor can draw from this theory is that if price is divergent from value, and most of the time it is, then there exists an opportunity to make money either by selling a stock or buying it. Unlike the secondary market where shares are traded 5 days a week, private deals on the other hand happen more or less in the fair value range because they do not get inflated by leveraged buying or nor get depressed by margin selling. It is easier to get a better deal buying listed securities bear market than in buying real business the direct way. Conversely, it is also easier to get a bad deal in the listed securities bull market when compared to real business. But being a good investor is different from being a good businessman, because a businessman can lose 100% in one go, but the risks of investing can be controlled by diversifying across stocks and sectors. Long term wealth cannot be generated by short term trading. People who buy shares for a few hours as part of the day trading plans are more dependent on the mood and emotional swings of their fellow investors than on the fortunes of the company. Investors who identify one big investment idea every 12 months make more than people who find a new stock to bet every 12 hours. The short term trader would buy and sell shares of a Punj Lloyd with an as much gusto and ease as they would for a Punjab National Bank. People who participate in a fierce short term trading are actually playing a game of chance, as most short term traders engage in buying and selling shares because they get hooked to the charm and excitement of fluctuating prices, then with the objective of making big money. This hobby slowly becomes a habit and then an addiction before making the participant a compulsive gambler. Unlike a profession, habits and hobbies cost money, whether it is playing golf, rock climbing, bird watching, photography, smoking, or even drinking. All addictions come with a price tag, which the non-serious investors keeps paying to the market day in and day out. The compulsive gambler, though, enjoys paying up the money as he derives a sense of satisfaction out of it. He enjoys by losing, so continues to lose just to enjoy. The science of zigzags is an opportune way to go from riches to rags. Most short term traders base their buying and selling strategies on technical analysis, which generates buy and sell signals on the basis of moving averages, breakouts, breakdowns, overbought, oversold, head and shoulder, etc. While these tools are essential for the people who are focused on short term trading, too much of reliance on these kind of strategies will not allow an investor to make big money from the market. The focus of investing should be to buy stocks that carry a potential to move up to 10 times, and not on the ones that promise a random 10% up move. A continuous learning process. All stock market participants engaged in what is called a continuous learning process. Contrary to popular belief, there are no experts in this game, and each transaction fulfills two motives. Either it teaches the investor a new lesson or increases his conviction to an old one. Unlike a formal education program where a candidate gets to make money only at the end of the learning session, a stock market participant gets to make money while at the job, even as he continues to learn till the very end. Towards financial freedom. Early retirement is the biggest lure for hard work, and anyone who works wants to reach that stage in life where he does not have to work for money while his money works for him. But achieving these goals takes a lot more than making a few profitable investments. As an investor, will have to work from all sides. He would need to increase income, reduce expenses, while simultaneously keep making profitable investments. Once his investments starts expanding in value, he will have to restrain himself from taking early profits, letting the profits run unless there is something wrong with the company is the only way to make enough from equity investing. It is fair to assume that the initial amount that an investor brings to the table will be small, but if he manages to put this on the right stock which shows the right kind of price movement, then as an investor he would be compelled by reasons and advice from others to take money off the table, not realizing that no one makes a fortune by selling a stock that has just doubled in price. An investor has to be lazy in taking profits and agile in cutting losses. Good companies are supposed to occasionally get ahead of their current fundamentals, and if the stocks that an investor has bought moved up with the company's prospects, it makes sense to hold on or even buy more, especially if the underlying business is indicating excellent prospects ahead. Buying more of a stock after it has moved up from an investor's initial purchase price is a lot tougher than selling it to lock in the gains. But the tough decision is more often the right decision. As a part of an investment strategy, an investor seeking financial freedom through the equity route should focus on smaller capitalized companies that are leaders in their sectors and growing revenues at a fast clip, preferably with a growing dividend yield. A small cap in stock works on a small base with potential for supernormal growth, whereas the life jacket of dividend yield protects the investors from the downside movement in the stock. However, once the stock has been bought, there will be several instances when an investor will be faced with the dilemma of cashing out for safer investments or for using the proceeds to buy the smaller luxuries in life, like putting up a down payment of a car, a flat TV screen, buying jewelry for his wife, a nice holiday, or even a new sofa set. Funding these expenses through an investment that has gone right boomerangs back, as it converts an appreciating asset into a depreciating asset, which negatively impacts the process of wealth creation. The process of getting rich for a big and everlasting smile entails sacrificing a lot of these small happy moments. The option for the investor should be clear as to whether he wants to be happy in these small moments or create a lifetime of happy moments. To do the latter, he would have to struggle, wait, dream, and at times feel bad when the stocks that he has bought fall in value while his neighbors take off for that long summer vacation to the Alps. The risk that an investor will take in this process will also accentuate as he should allocate the maximum amount to equities and refrain from diversifying. Term insurance term insurance policy for the life of the earning member is a must, as the concept of buying pure insurance covers should be revisited while doing away with the artificial frills of money back and endowment linked insurance plans. To attain financial freedom, an investor must strive to have at least a corpus of 50 times his annual expense. 50 time annual expense means an investment corpus of 2.5 crore for a family that intends to spend 5 lakh on household expenses each year. The logic behind this 50 time number is that at a yield of 2%, which all decent portfolios should generate over time, the dividend income of his portfolio should take care of his daily expenses. If in some years the yield falls short of 2% mark, then he can sell some shares to make good the deficit and hope to catch on in the later year, as the yield of a group of carefully chosen business should grow at a rate significantly ahead of inflation. The path to financial freedom is not an investor's personal journey. He has to get his immediate family, which includes his spouse and other active members, into the process. The process of an investor postponing immediate comforts for the benefit of future luxuries is a family decision and not an individual one. It can't be achieved by the pains and sacrifices of a single member, so there has to be a conscious family decision to either participate in the immediate sacrifice for the future good, or else engage life as and when it comes. It is generally difficult to get the family consent, as not all members are willing to participate and sacrifice the present comforts for an uncertain and unknown future dream. The fight remains between a bird in hand and several in the bush.